For most of modern history, China did not try to build a separate financial system. It did not plan to challenge the world. It did not talk about replacing anyone. China simply wanted to grow, trade, and get richer. It joined the global system believing that cooperation would bring stability. But over time, China learned a hard lesson that many nations learned too late. In finance, dependency feels like trust at first, until the moment trust is used against you. In the late 20th century, the global financial system had clear rules. The dollar sat at the center. Trade moved through Western banks. Payments cleared through Western-controlled systems. Loans, insurance, and capital flows were shaped by institutions built after World War II. China entered this system as a participant, not a designer. At first, it worked. China exported goods. Dollars flowed in. Factories grew. Cities expanded. Millions escaped poverty. The system rewarded efficiency, and China became very efficient. For a long time, there was no reason to question the structure. But beneath the growth, something uncomfortable was forming. China realized it was rich, but not powerful in finance. It produced real goods, but did not control the pipes through which money flowed. Its savings were large, but stored in foreign assets. Its trade depended on currencies it did not issue. China was strong in production, but weak in control. This imbalance did not matter in calm times. But financial systems are not tested in calm times. They are tested in crises. The first real shock came from watching others fall. China observed how countries that depended heavily on the global financial system were treated when politics changed. Assets were frozen. Payments were blocked. Access disappeared overnight. These actions were not military. They were financial, silent, legal, and devastating. China paid attention. Trust, China realized, was conditional. If your money flows through someone else's system, it can be stopped. If your reserves sit in someone else's currency, they can be restricted. Dependency does not feel dangerous until pressure arrives. China asked a simple question. What happens if the system turns against us? That question changed everything. China did not leave the global system. That would have been impossible and dangerous. Instead, it began to build parallel systems quietly, patiently, without confrontation. The goal was not dominance. The goal was survival. China began strengthening state control over banks. Western systems favor private finance. China favored centralized oversight. This allowed the government to direct credit, slow capital flight, and stabilize crises internally. It was not efficient by Western standards, but it was resilient. China built its own payment infrastructure. While the world relied on systems controlled outside its borders, China created alternatives, not to replace global systems immediately, but to ensure continuity if access was lost. Redundancy became strategy. China also worked to reduce dependence on the dollar without openly attacking it. Trade deals were settled in local currencies. Bilateral agreements replaced global ones. Reserves were diversified slowly. Nothing dramatic, nothing loud, just preparation. One of the most important lessons China learned was that finance is not neutral. It reflects power. Systems built by one group naturally serve that group's interests first. China did not see this as evil, it saw it as reality. And reality demanded adaptation. China's leaders understood history well. They knew that empires rarely collapse from invasion alone. They weaken through overdependence, through trusting systems they do not control, through assuming access will always remain open. China refused that assumption. Instead of letting markets decide everything, China kept control over capital flows. Money could not move freely in and out without oversight. This frustrated investors, but it protected stability. China chose friction over fragility. Critics called the system inefficient, but efficiency was not the priority. Continuity was. China also invested heavily in real assets, infrastructure, manufacturing, energy, things that exist even if financial access disappears. While others financialized their economies, China physicalized much of its wealth. Factories cannot be frozen. Railways cannot be sanctioned. Ports do not vanish with policy changes. This was not ideology. It was insurance. As global tensions increased, China accelerated these efforts. It expanded regional trade systems. It supported institutions where influence was shared, not centralized elsewhere. It encouraged technology platforms that reduced external reliance. Still, China avoided confrontation, because the goal was not to break the system, it was to never be trapped by it. China understood something many nations ignore. Financial power does not need to be used often to be effective. It only needs to exist. The knowledge that access can be removed is enough to shape behavior. China did not want to live under that shadow, so it built options. This is why China's financial system looks different. It is not designed for maximum freedom. It is designed for maximum endurance. It sacrifices speed for control, openness for predictability. To outsiders, it looks restrictive. To China, it looks safe. Trust did not end because of one event. It ended because dependency became visible. And once dependency is seen, it cannot be unseen. China still trades globally. It still uses existing systems, but it no longer assumes they are permanent or neutral. It plans for interruption. That is the real story. China did not build its own financial system to dominate the world. It built it to make sure no one else could quietly dominate China. And in finance, that difference matters more than anything.